Let's keep the conversation going now with Todd Rosenbluth. He is head of research over at TMX VettaFi. Todd, great to see you in studio.
Great to be here, thanks.
I wanted to start with small caps, but I feel like we have to talk about the store of value smackdown that Eric just highlighted there. It is interesting to see this twin rush into gold and Bitcoin.
Yeah, we're seeing investors embrace both of those alternatives. Obviously, the price has gone up. That's how gold is actually, I believe, at a record high, and we saw not only GLD, but GLDM. What's interesting to me is also the miners that are tied to this. So CoinShares has a Bitcoin mining ETF, WGMI, that's actually up double the price of IBIT, which is, of course, the leading spot Bitcoin ETF. Sprott has a gold mining ETF, I believe is up 95% this year. So we are seeing the equity exposure with those alternatives actually performing very well at the value level, even though there hasn't been as much interest.
What's your sense of whether this is new money going into gold and Bitcoin versus an allocation from somewhere else?
So I think we're seeing investors, and we're based on the surveys that we're having with advisors, they're increasingly comfortable with alternative investments, alternatives being something besides stocks or bonds. Bitcoin has obviously done better, obviously, because I think I was on in the past a bit more skeptical as to the demand. It's continued to have demand. But it's interesting to be able to see. So I think instead of it being 60-40, there's now a slice of many people's portfolios that are alternatives. Some are owning both gold and Bitcoin. Some are choosing one over the other.
All right, it wouldn't be you if we didn't disagree. And we're going to talk small caps. So you've brought all these, you have like 4 paragraphs of like why small caps are finally happening. And they have had a little bit of a nice run. But to me, this seems like another false positive, another head fake. And I'll tell you why. Small caps used to be where you got new IPOs that were like the future stars. But now those private companies wait till they're really big, then they enter in as a large cap. It's sort of like skipping college going right to the NBA. And so small caps is really just the ones that could never make it or the ones that got rejected from the large. So why would I buy that?
So first of all, let's stick the sports metaphor for a second. You really can't do that. You actually have to go and spend a year in college for the most part. But let's not delve into those weeds. Let's talk about small caps. What we at VettaFi have seen is we saw nearly a 50% spike in the traffic to our small cap ETF list that we have at ETF Database. That's in August relative to July. So investors are doing research about small cap ETFs. What's interesting, because you showed on the chart earlier that IWM has been in net outflows. It's actually among the top 10 most outflowed ETFs this year. We are seeing ETFs and interest in ETFs that are in other more fundamental or factor-weighted approaches. So we've been talking about S-Flow, which is a Victory Shares small cap free cash flow ETF, higher quality companies with a growth tilt to it. That ETF has seen stronger demand than IWM, and it's also outperformed. So that's a double benefit.
All right, well, listen, I'm going to just say this right now. I am in the market for a steak dinner bet.
Oh, gosh.
I will bet you that large caps beat small caps this calendar year. You don't have to answer now, but just think about it.
So we have to start it from this point. We'd have to start from today because large caps have a significant outperformance. So yes, starting, I guess, starting with the trading tomorrow.
Okay.
Let's pick the iShares S&P product. So the S&P small cap 600 versus the iShares S&P 500. And Katie promises to write about the winner, I think, on air.
I do have a newsletter. I do have a platform.
Okay. And Katie and I are coming along for the ride.
Yeah,
certainly.
Yeah, Eric will happily pay for you.
Who do you like in this?
Who do we like?
Yeah.
We're just journalists. We don't have an opinion.
Impartial.
I do like steak, though. No vegetarians on this set. Let's switch gears here. Let's get back to the ETF landscape. I do want to talk about active. We had a lively pre-show call about the state of active management, and you highlight in your notes that there's new entrants in this space. Baring Capital, for example, coming out with their own filings for active funds. Some of the fees, though, on these products, Baring Capital in particular, their highest price proposed fee was 1%, which to me highlights the culture shock of these old school mutual fund managers coming into the ETF world.
So we're seeing that investors are increasingly embracing active ETFs. I think the Bloomberg data would certainly support that. It's close to a third of the overall flows. We think many firms are coming in with their pedigree and what they're known for. Barron is known for active management. We think they can have success coming out of the gate as more people become become aware of the products. I don't think fees are as important with active ETFs the way that they have historically been with index-based products. We've seen successful products that are close to that level. Maybe they're not exactly at that level. I think firms like Barron, we've seen MFS come in and talk about their products. Cohen & Steers is another firm this year. We've seen the traditional mutual fund companies start to transition into the ETF space. And of course, we're going to see more of that if and when we get the ETF share class approval by perhaps the end of the year.
I want to go back to what you said, why you don't think that fees matter as much for active funds. Why is that? Because they matter tremendously when we're talking about passive funds.
So I think many investors are looking net of fees at the performance. So if the fund performs well, even with that fee, you're paying for the active management, the security selection efforts. You're paying for those resources. I think many advisors, especially those that are legacy mutual fund investors, they're more comfortable doing that. Not everybody is going to. Some folks are going to look for the low cost. I think you're going to talk about Vanguard in a bit. They've got low cost active ETFs. There's others that are out there. We think there's lots of room. It's a very large ETF marketplace to play in.
Speaking of that, let's take stock of the issuer horse race. We have Vanguard at top, no shocker, at $229 billion this year. BlackRock second at $181. Even with that Bitcoin bump, they're still a good degree behind Vanguard. And then it's a country mile to the next one, which is JP Morgan. What's your take on the leaderboard this year? And do you have like a dark horse? I want to get what's an issuer that's out of the top 5 or top 10 that you think is going to shock us with a run up the charts?
So I think we're seeing two different things happening. Obviously, low-cost index-based products continue to gain traction. You showed it on your leaderboard beforehand. And Vanguard and BlackRock and State Street, to a lesser extent, is playing in that space and having success. I think the firm I'm watching as we head into the year and into 2026 is Fidelity. Fidelity is, I believe, the 5th largest active ETF provider. As active ETFs continue to be embraced, I think Fidelity is a firm to be paying a close attention to.
All right, so we have 2 action items here. We're going to follow up on small caps versus large caps. We're going to keep an eye on Fidelity. That is Todd Rosenbluth of TMX VettaFi.